I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Let's get straight into the burning issues in private markets. Retailers keep filing for bankruptcy, which will likely translate into more pain for some mall owners. Plus, food delivery indigestion with companies running into potholes after receiving billions of dollars from private funds. And cashing in on the baby shark craze, the family behind the catchy tune is now sitting on a rapidly growing multi-million-dollar fortune. So let's dig into some of these burning issues. With me is Bloomberg's Shonali Bosick, Adam Temkin, and Ellen Hewitt. Let's get started with those struggling retailers. The latest insolvency is Fleetwood Industries, which makes fixtures for retailers. This is relatively small, but its clients are not, and it's symptomatic of a larger issue in the retail space. Please explain.
This is a very classic supply chain issue. If your client is JCPenney or Neiman Marcus, which is the case for Fleetwood, then if they're having troubles, then you're going to have some problems too. All they're doing is making cash registers and tables for these companies.
And they're filing for bankruptcy now. So is it surprising that we're still seeing brick and mortar retail bankruptcies at this point? Or is it more surprising that we're not seeing as many, that we're seeing a sort of flattening out here?
Well, I think we wait a little bit, right? Because I think we will see more. That's the thing about it. And so when you have all these large-scale investors that don't really want to invest in these companies anymore, they're really worried about the debt structures because of the Amazon effect, insurance companies, pensions, then yes, there's got to come a point when people get very worried about this industry at large.
So wait a little bit and there may be more, which brings me to you, Adam, and the effects of retail bankruptcies on commercial real estate. Barclays recently coming out and raising some concerns about commercial mortgage debt, with so much of it backed by retail space. Please, can you outline what their concern is?
While Barclays said it may not be systemic to the CMBS market, struggling retailers like JCPenney, Sears, Macy's, if they vacate or go bankrupt, this could be a real problem for CMBS, and it is not priced in. Now, some years of CMBS, 2011 to 2013, have more of this stuff in it. And for those, it's not priced in right now. And this could be a problem. Another problem, a lot of these 10-year loans coming up for refinancing. Some of these struggling retailers, borrowers in malls, may not be able to refinance. They won't meet the criteria. If that's the case, again, could be problematic for certain CMBS, according to Barclays.
Right. The only issue is people have been trying to profit from this trade for a while, this idea that there will be pain in commercial real estate stemming from the retail apocalypse. We haven't seen it. How have people tried and failed to profit from this? Starting
from a couple of years ago, a handful of hedge funds, as you know, were shorting the CDS, the CMBX market against retail. Well, guess what? It came up short. Not enough loans were going delinquent. One hedge fund, Alderhill, just closed down that trade. So while there's problems, there's not a huge problem where there's a lot of delinquencies. Mall landlords are getting more flexible. They're negotiating. They're bringing in health clubs and churches. They're making it work. So that trade, it's not really working right now, the short seller trade.
All right, which brings me to you, Ellen, which is private funds have been betting big on food delivery, but there are growing signs of weakness. The latest with Uber today, with Uber Eats and Grubhub, and they've both taken hits. Ellen, what's the big challenge for these companies?
Well, I think as presented in Grubhub's earnings last week, the concern is that food delivery will never really make that much money. And this is something that Grubhub even told its investors, that the logistics part of the business, as opposed to advertising or other ways that these companies can get revenue, that logistics part may never really be a high profit business. And I think that spells some pretty troubled times ahead for some of these late stage private companies such as Postmates and DoorDash that are hoping to maybe go public, but haven't really pulled the trigger yet.
Can you give us a sense, Ellen, of how popular these food delivery services have been with private equity and venture funds?
Hugely popular. This is a place where even SoftBank has placed a bet on DoorDash in the hundreds of millions of dollars. They're really hoping that based on the market size and the habits that some people have around making these purchases all the time, that this is a really big market they want to be a part of. I think the issue that they're coming up against is these have always been framed as growth companies that are trying to get market share, trying to win. unclear if they'll ever really be able to turn a profit, and that's becoming more important now as the public markets look to these growth companies and venture and are assessing whether they're a good investment or not.
Ellen, thank you so much for taking the time, and to all of our reporters. It brings us to our next guest, Bloomberg opinion columnist Connor Sen, also a portfolio manager. And I'm wondering, Connor, from your perspective, there are so many issues that get raised by some of these food delivery services and the troubles that they've been having. The one is the economic fallout, and you raised this recently, particularly with restaurants. Can you explain?
Sure. So restaurants have been challenged by labor costs and just, the restaurants are always a low margin business. And so they've looked to delivery as a way to juice growth. And so, because DoorDash and Postmates and these companies have tried to gain market share and haven't been focused on profits, it's sort of been a symbiotic relationship between restaurants and delivery. But now if you have to see delivery companies cut back to get to profitability, it raises the question of what that's going to do to restaurant revenues downstream.
The other issue that I've seen raised is who invests in some of these meal delivery services. And we've seen that even mutual funds have been getting in before they go public to some of the private shares. How much of a concern is that?
I guess it depends on how much they've invested, because obviously you look at the share price of Grubhub after its earnings miss or Uber today, and the public markets is valuing this business a lot less than it was, say, 6 months ago. And yet earlier this year, private markets valued DoorDash and Postmates at a combined valuation of around $15 billion. And so if you have those on your books, the question is, where should you mark them, and what kind of hit write-down should you take?
Well, I mean, I guess that the concern that some people have raised is that the Fidelities of the world, and even the Vanguards, although less Vanguards, more Fidelity, have gotten into private shares right ahead of IPOs, and that they don't have to really value these shares on some sort of standard metric. So they might end up being able to have more flexibility in valuing these at much higher levels than the reality. I'm just wondering, do you view this as a systemic risk, or is this more of an idiosyncratic issue?
I would guess it's idiosyncratic for now, just because there doesn't seem to be a whole lot of widespread damage. I mean, there have been a lot of headlines this year, but in terms of dollars, I don't think it's significant relative to a $20 trillion U.S. equity market. But it's certainly a behavior that we have to look for going forward to see if they pull back or keep going.
When you wrote about the gig economy, when we talk about Uber Eats or even Uber or DoorDash, a lot of it hinges on the gig economy. You recently wrote that it's a dead end. Why did you say that?
Well, I think obviously Grubhub, as Ellen mentioned, has said that delivery will probably never be significantly profitable. And also, given the labor market we see with unemployment at 3.5%, wage growth rising the fastest for workers sort of the lower end of the labor market, Bank of America just actually raised their minimum wage to $20 an hour. And then you have legislation in places like California about how to classify these workers. It's just not clear where you're going to get the workers to run this business at a profitable level. So
when you talk about some of the companies that are seeing their valuations decline, and I know that you said that you view this as more of an idiosyncratic issue, when does it become systemic, given how much money has been funneled in?
I guess the question is, first, what the public markets decide these companies are worth, and then secondly, just in terms of how many dollars were invested at these companies at what prices, and then what can those mutual funds get for these companies at some, whether it's in private markets or public markets down the road. Going forward, do you think that private markets increasingly hold less value than even public equities at this point, given some of the pitfalls that we've seen? I think private markets have the attraction of not having that mark-to-market volatility, but it doesn't mean the risk has gone away. And so sort of for this decade, they've had it both ways, where they've had the momentum and growth of these stocks without the volatility you see in public markets. And I just think we're sort of seeing a reckoning there where, ultimately stocks do go up and down in price, whether they're public or private. All right, Connor Sen of Bloomberg Opinion, thank you so much for being with us. Coming up, this week's power player, Chris Ailman of CalSTRS, the chief investment officer of the second largest U.S. pension fund, preaches a little patience with real estate investments.
We're not going to rush into real estate either. This is a very frothy market, so we're going to take our time, probably actually be a little bit of a net seller for the next year or so.
I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for Power Player, or look at some of the most notable names in private markets. The California State Teachers Retirement System, or as it's known, CalSTRS, is the second largest U.S. pension fund at $242 billion. It plans to increase its allocation to private equity and real estate assets as it aims for 7% annual returns. I recently talked with Chris Ailman, the fund's chief investment officer, about reaching that goal amid a backdrop of ultra-low rates.
The low bond yields are a heck of a challenge. Negative interest rates, I mean, it's not in the textbooks. So investing in the USA and U.S. interest rates, I think we can balance the portfolio and make the 7 over long term.
So, Chris, I was looking at your allocations, and currently private equity stands at about 9%, 8.8% of the portfolio. Your target allocation is 13%. How are you planning to get up to that 13%?
The answer, Lisa, is we're a steady pace investor. So we're going to be allocating into private equity as we have for the last couple of years on a steady basis over the next few years. We're also going to be looking at, as a lot of people, co-investment opportunities, and if it comes up, a secondary investment where partnerships we might be in now become available from other people. We'll look at those as a way to buy into the market and increase our exposure. We're not going to chase that 13% target. We're investors, so we want to be a steady investor over time, spread out over the vintage years as best we can.
I want to switch gears a little bit, Chris, from private equity to real estate, because that's another area that I believe you're thinking of increasing your allocation to. Currently, it's about $32 billion of the overall portfolio. How much do you plan to increase that?
Real estate right now for us is about a little over 13.5%. Our asset allocation that we're going to be discussing here in November, the board is likely to raise that long-term target to as much as 15%. We're not going to rush into real estate either. This is a very frothy market, so we're going to take our time, probably actually be a little bit of a net seller for the next year or so, and then get back into the market over time as we think prices might be reasonable. When you look at cap rates, particularly on the big gateway cities, New York, Boston, D.C., out here, Los Angeles, San Francisco, Seattle, prices are through 2007 prices. So most of what we've done to date has been build to suit, a little bit of development, a little bit of property improvement. And what we've really found in real estate is buy and hold.
The return objective for the real estate segment is 7.7% versus 5 to 6% kinds of returns that you've gotten from the portfolio. So how is that going to sort of change over time, or is this going to be basically sell, try to get some dry powder, and then deploy it if there is some sort of downturn or correction?
Well, if I could time this market, I definitely would try to do so, but even Sam Zell has found that's a bit challenging to do. We're going to have dry powder. We're going to be an investor and look for opportunities. That's an area where we've actually found, because real estate is so diversified and so local, we've actually found it valuable where we own a couple of real estate operating firms, so we're able to get into the business of being a general partner and then move the capital in and out as we see opportunities in the gateway cities, the secondary cities, and then pay attention to the population moves.
So where do you think is the biggest opportunity within real estate, both when it comes to the type of housing as well as location?
Wow, real estate is right now is fairly priced in almost every single category. We recently liquidated a senior housing portfolio because that area has gotten so oversaturated. Apartments have gotten oversaturated. I'm amazed to see the number of cranes going up in terms of construction in some of the major cities. So for us, it really is all kinds of specializations. We've looked at student housing as an interesting area, affordable housing, particularly out here in California, as an interesting area. We've been doing some development where we're taking development risks, particularly in the medical field, office buildings that are really designed for specific uses. We have a very major development that's worked really well for us up in Cambridge, in Boston, and in other locations of trying to be very targeted.
Chris, I know that you have performed better than other public pensions if you look at the averages, but pensions have steadily been lowering their returns expectations from about 8% in 2001 to 7.2% now. They're still missing it, or they have over that period. Are you concerned by some of the risk-taking behavior that you're seeing by some of your peers?
I am seeing some people move in different risk parts of their portfolio to make up for that low fixed income return, and I think that's where everybody has to be careful. When you look at corporate debt, you got to pay attention to covenants. The bottom line in investments is always true, Lisa. You've got to do your due diligence and you got to do your homework.
That was Chris Ailman, Chief Investment Officer of CalSTRS. Coming up, that song that is stuck in everyone's head. Apologies, not really. The family behind Baby Shark, which has nearly 4 billion hits on YouTube. We're going to be talking about that. This is Bloomberg Money Undercover. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now to our Billionaire Beach. And this week we are focused on the one in the White House. President Donald Trump, a lifelong New Yorker, has changed his primary residence to Florida. And this is a move that could benefit his re-election campaign, but it also is his tax bill. The president tweeted, 1600 Pennsylvania Avenue, the White House is the place I have come to love and will stay for hopefully another 5 years as we make America great again. But my family and I will be making Palm Beach, Florida, our permanent residence. Joining us now from D.C. to discuss this story is Bloomberg's Laura Davison. Laura, can we just start? It's not just President Trump. Carl Icahn, also another billionaire, has done the same. How much do they save moving to Florida?
Well, it really depends on how much they earn, but it can range up into the millions for someone like Carl Icahn, or, we haven't seen Donald Trump's tax returns, but if he's as wealthy as he says he is, they're saving huge on this state and local tax deduction. Basically, Donald Trump's own tax law limited this deduction, which really hits folks, especially higher income folks in New York, New Jersey, Connecticut. That deduction used to be unlimited. Now it's only $10,000. So you're kind of seeing about 60,000 people from New York move to Florida last year, and you're really seeing that migration for some very, very wealthy people where they're saying, look, we can save not only on having Florida's a zero income tax state, so we can save on our federal taxes as well as on our state taxes.
Laura, Florida has had a lower tax rate for a long time than some northeastern states. How much has this move accelerated, though, on the heels of the recent tax changes?
We've seen some high-profile cases, Trump and Icahn being kind of the two most prominent, as well as other hedge fund managers moving themselves as well as their businesses down there. But it hasn't really been detrimental to New York State yet. You're seeing maybe some people who are already going to make that move accelerate it. New York Governor Andrew Cuomo had said, look, this is going to be devastating for the state. We're going to lose our entire tax base. So far, at least in the New York tax revenue numbers, they haven't seen that collapse yet.
What about Florida? How much is Florida benefiting from having these billionaires move to its state?
Well, it depends how much you want billionaires in your state, but certainly that's going to be helpful for them, for their tax base. They're presumably going to buy real estate. They will, if they move their businesses down there, even if they won't be paying income taxes to the state, they'll theoretically be generating other revenue that Florida can then use to fund whatever projects they want to.
Well, Laura, you said theoretically, and I actually want to dig into this because some people have proposed that they will have to raise revenue, increase taxes to accommodate all of these new people who are coming down by fixing roads or building schools. Where is the conversation on that?
That's really, it's still at the state house level. They're trying to figure out. Florida, as we know, is a very purple state, so you have a wide variety of opinions, and they're still trying to figure out, okay, how much should we invest in, education, in infrastructure? We're not going to see any infrastructure spending on the federal level likely for at least several more years. So that's something that they're going to have to come to grips with and look at, into projects like light rail and fixing roads if they have a, kind of an influx of residents coming to the state.
Bloomberg's Laura Davison, thank you so much for that. Now to a story, and to be more particular, a song that has made millions for its catchy tune. It's also gotten the negative press of hosts on comedy shows worldwide. Baby Shark has been seen by billions on YouTube and even inspired the Washington Nationals to a World Series win. In case you haven't heard it before, here's a short clip. Kind of painful, I gotta say. As a parent, let's bring in Bloomberg's Linan Nguyen to discuss the family behind Baby Shark. And Linan, aside from just punishing people with the song, I do want to talk a little bit about the money because it has made big money for a particular family. Can you talk a little bit about that?
That's right, Lisa. And just a little Baby Shark origin story for you, if you'd like to hear it. Our colleague in Singapore who covered the story actually told me that Baby Shark is a traditional Korean song that's now passed into the public domain. And so that's where it comes from. So it makes sense, right? If folks song then catches
Doesn't sound like a folk song.
Catches on around the
All right,
world,
so who's
right?
cashing in?
Okay, so who's cashing in is Kim Min-seok. His family owns a stake in both Smart Study, which is his own startup, and also the family business. And so combining all the stakes of all the people in the family, we've kind of got to this figure of $125 million.
Okay, so $125 million, which is the value of Baby Shark Okay?
You did it.
I did it.
You
I
sang
did it
it.
on air. Yes, I did. But I'm curious, you know, at what point or what's to sort of stop that from just sort of disappearing in terms of the popularity or the revenue stream? I mean, how do they even make the money?
Well, this is the thing. You have to kind of catch the lightning in a bottle. That means you have to capitalize on the ad revenue. You've got to use that position in the Billboard Top 100 and sell some singles or sell some downloads of the song. You've got to put it into licensing and get the song into other programs. You know, sell it to firms like the Washington National so they can use it in their games.
All right. So the company that owns the rights that's gotten this amount of money, the $120+ million, is called Smart Study. It's privately held. What do we know about them?
So we don't know a ton about them, except that the founder, of course, from this family, started out in gaming companies, which is really interesting also. So obviously he has a knack for knowing what people like in games and making things fun. And so they created this kind of spun version of this traditional song, and that's what really caught on. And also they do programming that's kind of like a app to video. So, you know, they use educational programs that you can use on your phone.
But how much of their revenues come from Baby Shark and the advertising revenue from there versus some of these other programs?
We haven't split it out, so but you can be sure that a lot of that money, you know, comes from this program. I mean, the revenue for the company last year was only $34.3 million, and if we're looking at 125 this year, you know, that's a big bump based on this little shark.
You know, it's just amazing to me how much money has been raised from YouTube millionaires, et cetera. And when you think about something like Baby Shark, that is irritating for every parent who has to deal with it, it's just interesting to think that somebody is absolutely cashing in and continues to with the musical and everything else.
Yes.
Linan Nguyen, thank you so much for being with us today. Speaking of big money, it's time for this week's big number. According to the Center for Economic and Policy Research, in July, more than 11 million people are employed by the private equity industry. It is one of the reasons why they are getting more and more scrutiny by politicians and the media. And of course, they are hiring more people as they continue to be a profitable and sought after way to earn profits. That does it for us. Reminder, you can watch us each Tuesday at 1 p.m. New York time, 6 p.m. in London, 2 a.m. in Hong Kong. From New York, this is Bloomberg.